Assalamualaikum and hi everyone. My name is Nurul Christina.
Assalamualaikum and hi. My name is Nufarisha Natasha.
Assalamualaikum, hi. My name is Lufi Anik.
Assalamualaikum, hi. My name is Nubaiki Zaliani.
Hi, Assalamualaikum and good morning everyone. My name is Nabila Adriana binti Sapian.
Good morning everyone. Today I like to explain what working capital is, why it matters and how business manage it. Working capital is basically the money a company needs to run its daily operation. It calculates by taking current asset and subtracting current liability. The result is positive. It means the company has enough short-term resource and cover its short-term debt. Current assets include things like cash, inventory, and account receivable. These are things that can be converted into cash in a year. Current liability, on the other hand, are obligations that need to be paid within the same time frame, like wage, bill, and supplier payment. The main purpose of working capital is to keep business running smoothly. It helps companies pay for the things like raw material, staff salaries, electricity, and rent. Without enough working capital, even profitable business can struggle with cash flow and delay payment. Now, the amount of working capital a business needs depends on a few factors. For example, the type of business plays a big role. A supermarket needs to steady working capital to keep shelf stock, while the construction company might only need large amount of specific project stage. Other factors include the production cycle, seasonal demand, and company size. Because of this, companies choose a different working capital strategy. Some take an aggressive approach trying to reduce the amount of the money tied up in the working capital so they can earn more return elsewhere. But this approach is risky if cash flow is tight. Others use a conventional approach, keeping more working capital is as a safety net, but this might reduce profit. It's all about balancing risk and return. According to Theory Saini 2023, it says a company needs to choose working capital policy to balance risk and profit, whether it's aggressive or caution. From the Theory Hayes 2025, the main goal of working capital management is to make sure a company has enough liquidity to meet its short-term needs and keep operation going. At the same time, it should help the company work more efficient and increase profitability.
Hi, Assalamualaikum and good morning everyone. Today I'll be taking you through a financial analysis of QE Engineering Berhad based on their financial statement for the year ending 30 June 2022. Well, look at the board balance sheets, understand key financial data, point and briefly interpret the company financial hit. Let's begin. So first, we look at the balance sheet, which gives us a snapshot of the company's financial position as of 30 June 2022. For the assets, as we guys can see, QE Engineering got the total asset amount to RM 115,000. So look at the breaking this down the asset, which we have temporary and permanent assets. For the temporary and current asset, we got including account receivable with amount to RM 25,000 ringgit. For the cash, RM 22,000 ringgit, and the last of current asset is inventory with total amount RM 45,000 ringgit. So this gives a total current asset value of RM 92,050 ringgit. After that, we have a permanent and non-current asset including gross basic asset with amount 116,000 ringgit. And then for the last, depreciation is RM 38,000 ringgit. So net basic asset amount to RM 78,000 ringgit. When we sum it up, the total of asset we got shown as RM 115,000 20,000 ringgit. Now, we go to the liabilities and equity side. Look at the liabilities. We have account payable Rm 22,000 ringgit, account Rm 18,000 ringgit, not payable Rm 39,000 ringgit. For the last liability of long-term debt, we got 22,950 ringgit. And then so total liabilities are Rm 61,950 ringgit. Next, we go to the equity portion. For common shares, Rm 31,500 ringgit. Return earning Rm 26,550 ringgit. That gives us total equity of Rm 5x050 ringgit. And then we sum it up the total both of liabilities and equities. We got the ratio about Rm 115,000 ringgit. This brief financial overview provide a good starting point for the furthers. More detailed ratio analysis often evaluation over multiple years.
Let's go through how to calculate the net working capital, or in the short form we call NWC. The formula is straightforward. Net working capital equal to current asset minus current liabilities. So in our example, current assets are 1,500 plus 25,000 plus 45,500, which give us 72,000. Current liabilities are 22,000, 8,000, 39,000, which totals Rm 69,000. So the net working capital will be 72,000 minus 69,000. That will conclude the 3,000. So we see the positive net working of 3,000 means that the company has more current asset than current liability. In simple terms, the company has enough short-term resources like cash, receivable, and inventory to pay off like company bills and obligation. That's why we say liquidity is okay. And a positive working capital allows the company to avoid cash flow issue, continue operations smoothly, and take advantage of short-term opportunities. Now, let's examine the current ratio, CR, another key liquidity indicator. So current ratio equal to current asset divide current liability. So we calculate CR will be 72,000 divided to 69,000 and will be 1.043 times. So this ratio tells us how many times the current asset can cover the current liability. A current ratio of 1.043 means the company has Rm 1.043 in assets for every each Rm1 it owns in the short term. Although it's slightly above 1, it's still a positive sign. It shows that the business is in a stable financial and can handle its short-term debts without needing to borrow or sell off long-term assets. So, in summary, a positive net working capital and a current ratio above 1.0 both confirm that the company's short-term financial health is solid. Yay! So, it reflects the good liquidity, low risk of cash shortage, and a strong operational efficiency. Thank you!
When managing working capital in our calculation, the most effective strategies that we choose is the hedging approach. So, why are we choosing this one?
Yeah.
It is because in the business finance, managing working capital efficiently is essential to maintaining smooth operations and long-term stability. So, let's go into a quick dive into it. The hedging approach means matching the maturities of debt or assets with the maturity of financial needs. This approach uses short-term financing for temporary current assets. It uses long-term financing with permanent assets and permanent current assets. This will help firms manage cash flow responsibility, minimize financing risk, and to avoid mismatches that could lead to liquidity problems. Permanent working capital requirements should be financed through long-term funds, while temporary working capital should be financed through short-term funds. Like any strategy, the hedging approach comes with both advantages and risks. Through hedging, there is reduction in the probability losses such as currency and price fluctuations, market changes, and other changes. So overall, financial stability is maintained within the system. It also provides greater flexibility related to your investment strategy. Through hedging, investors can get a greater degree of predictability in financial outcomes. There's also risk, which it is a technique that is used to reducing risk. However, it is not a perfect strategy and does not guarantee that the loss will be reduced. While hedging reduces your potential losses, it is also limits potential profits even when the market is moving in favorable directions. These strategies are complex and require an understanding of the market. For this approach, investors require resources such as capital and time. These resources could be utilized for other investments with higher returns. To wrap it up, the hedging approach to working capital management offers a smart, balanced way to manage risk and resources. It ensures that the business remains liquid, stable, and prepared no matter what the season brings.
I will be discussing working capital policy, specifically focusing on the moderate policy, which is the approach adopted in our case. Working capital policy refers to the strategy company uses to manage its current asset and liabilities. There are three types: relaxed, moderate, and restrict. Presentation, we are focusing on the moderate policy, which, as the name suggests, lies between relaxed and restrict approach. It adopts a balanced characteristic, neither too lenient nor too conservative. As you can see in Figure 1, which illustrates different policy approach, the moderate policy line lies between the relaxed and restrict policies, balance risk and profitability. Now, let's break down the characteristic of the moderate policy using Figure 2. The current ratio, which measures a company's ability to cover its short-term liability, is typically between 1.5 and 2.0. Net working capital is also moderate, meaning the firm maintains enough liquidity to meet obligations while still investing in operation. The days sales outstanding falls in the normal range of 30 to 45 days, reflecting a balanced collection period. Overall, this policy results in a balanced approach to credit and inventory management. One of the main assumptions of the moderate policy is that the risk is lower compared to a conservative approach, yet still allows room for profitability. The biggest advantage of using the moderate working capital policy is that they offer a reasonable assurance of smooth operation. That means the company can maintain a stable operation cycle, ensuring timely, resuming production and sales, while also ensuring that it does tie up too much cash in working capital. To summarize, the moderate working capital policy balances liquidity and profitability. It keeps current asset ratios and receivable at an optimal level, not too relaxed, not too tight. This strategy ensures that the company can meet its short-term obligations while still investing in growth.
In conclusion, this assignment helped me see that managing working capital is not just about financial number. It's about making sure a business has enough cash to keep running smoothly every day. From the case of the QE engineering Berhad, we learned that even with a lot of asset like inventory and receivable. A company can face cash flow problem if those assets cannot be turned into the cash quickly. This shows me how important it is to manage those assets properly by speeding up collection, reducing excess inventory, and controlling short-term debt. We also learn about different working capital strategy. The hedging approach with the match short-term asset with the short-term liability help reduce financial risk. But personally, we found the moderate policy the most practical because it balances risk and return without being too aggressive or too cautious. Overall, this assignment helped me connect classroom theory to real business practice. It gave me a clear understanding of how working capital decisions affect a company's ability to operate and grow. Thank you.